Hello and welcome to this video of future contracts in the stock market. Before we begin, let us first summarize the content for today. By the end of this video, you will know firstly what future contracts are. Then I'll give you an introduction to future curves and the key terms used in future curves. Then I'll tell you how to interpret the future curves. So without wasting any time, let us move on to the video. So what are futures? Like the name suggests, it's futures. That means it is related to some movement in the future. A futures contract is a legal agreement to buy or sell a particular commodity or an asset at a predetermined price at a specified time in the future. Future contracts are standardized for quality and quantity to facilitate trading on the futures exchange, which is open 24 hours a day. The buyer of a future contract is taking on obligation to buy the underlying asset when the futures contract expires, and the seller does the same on the selling side. Now, with the understanding of what futures are, let us move on to the futures curve. A futures curve is a graphical representation of all the future contracts available on a single day. The spot price is the price of the asset on the day of issuing a future contract. Both these graphs down here look similar, don't they? But the one on the left is a future graph and the other is a graph of price of a stock over time. The red dot shown on the left graph is the spot price on the present date, that is 1st Jan 2015. The futures graph shows the various contract prices that both the seller and the buyer agreed for trading the asset at a particular point in future beforehand. The futures graph was plotted on 1st Jan 2015, whereas the stock graph on the right was plotted over time. Now coming to the graph on the right, each point here represents the spot price on various dates from 1st Jan to the present day. So, as the date of future contracts come closer to the future contract price, the spot price and the future contract price converge. Now you must be wondering why to buy futures. Futures are generally bought and sold to save oneself from the volatility in the stock market. So if you don't want to lose money because of the volatility of market, then the futures is a good option for you. Thank you and enjoy investing.